everybody. This is AJ Brown with Trading Trainer, and we are here again with episode 4 of our 3 Dimensions of Vertical Spread serial. And I'm here with Jason Graham. And where we left off, Jason, was we had just gone through what implied volatility is, and we talked about probability theory, and you left us with a little bit of a cliffhanger. You left us with a vertical spread that you had placed, but it was inside that standard deviation. Hopefully you're going to tell us the answer, are you?
I hope so.
Oh, good. Let's get going then.
When we left off last time, we showed how our AutoZone vertical spread example was inside of our 1 standard deviation mark, in that our 240 strike, our short call, was inside of our standard deviation, which we calculated at 233.41. Let's talk about why we did that. Here's our standard bell curve. This curve gives an equal probability of the stock price of 100 moving up to 120 as it does to moving down to 80. If we're getting into a position and we're bullishly biased doing a bull spread, and we think that the stock has an equal probability to go down as it does to go up, well, we really have no business getting into that bull spread. So what we're actually seeing when we're entering a bullishly biased position is a skewed graph where price has a higher probability of getting up here than it does down here. And our probabilities that we have here, our percentages, would be a little different. Look more like this. This is a positive skew curve, and what we'd actually be seeing is if we were to price calls, we would say, hey, look, this stock is going up. The calls that are priced here at a 20% volatility should actually be priced up here at about a 40% volatility. They should be more expensive. However, most equities and most indexes are priced with a negative skew, where the calls are actually cheap and the puts are actually more expensive. If you remember the last time, we talked about how volatility is driven by the bid or the supply and demand of different options. So because the most of the market is bullish, our long-term traders thinking that price is going up overall, what they're doing is hedging their positions by buying puts. So out-of-the-money puts become higher in demand to hedge off bullish positions. A lot of people are also selling covered calls. Not a lot of people like you and me, but a lot of institutional traders. And so that brings down the price of these calls. So the price of the calls are coming down here by selling. The price of these puts are going up by buying. And so what we have is a negative skew. Here's an example. This is just a volatility chart. This is of Goldman Sachs. Whenever I took the slide, the at-the-money at the time was about here it is, 168. So here's our at-the-money vol at 22%. And as we go down out of the money, these are the puts, you can see how the volatilities start to rise. And this over here is a skew chart showing some different months. And you can see that the at-the-money, which is right here at this line here, is volatility's on, I don't know what it is, 20% or something, and it starts to rise as you go out of the money. The calls stay cheap. When it's in the front month here, they start to rise a little bit, but for the most part throughout their life cycle, they're cheap and even cheaper than at the money a lot of the time. So here I can demonstrate exactly how negative skew works, or how I envision it anyway. Here's our $100 strike price, our at-the-money option. It's a 20% volatility. It's going to bring us here and here. It's our log normal distribution. Here's our 90% volatility. It's got a 25% volatility, a little bit fatter. 80%, 30% volatility, a little bit fatter. 70%, 35%, 60 strike, 70%. I'm confusing myself with these numbers. These are all strikes here, and our volatilities here. And if you see what we have here, all these different strikes with higher volatilities, when you combine them all, you have your negative skew. So what do we do when we're trading we're bullishly biased against a position, and we believe that the skew should be positive based on how we see the chart or how we see the stock for whatever reason, but the skew is negative here.
And that means that our option traders are seeing things as negative, yes?
To a certain respect, it means that a lot of people are buying these puts as insurance. So they might not necessarily be options traders, but they're using options to insure their long stock positions.
Excellent. Thank you.
What we can do here is if prices are here on these puts and we think prices should be here, then we can sell these puts with the idea that they're overvalued and that they can come down to here. We can also buy these cheap calls here with the idea that they're undervalued and that they can come up here. But what we're talking about now is this half condor where we're selling these puts. You're going to be better off selling a really negative skew if you're selling up here. If you're wrong about this, if you're wrong about the direction, you will still be right about the skew being really negative and coming back into its normally negative type of distribution. But this is still a decent trade. So this is what we did with this AutoZone position. Our 240 strike is up here, 7 points inside of that standard deviation. If you remember, the implied volatility of AutoZone was something like 23.1%. What we essentially did by plugging our short strike in at 240, if you redo the math in a reverse calculation of this probability or of the standard deviation calculation, we gave it a 15.23% volatility. So with implied volatility at 23.1, we said that's fine, that's implied by the options. But what we're saying is, you know what, where I see volatility going in the near future is down to about 15%. So I'm going to use that in my standard deviation calculation to put in my spread. When we come back next time, we're going to talk a little bit more about how to use vertical skew to reduce the volatility risk and increase your edge in the half condor.
Excellent, everybody. So you're going to want to not miss our next episode of this serial because you want to definitely be able to get the edge. All right, everybody. Jason, thank you so much.
So long.
So long, everyone. Bye.